All right. Terminology in insurance contracts, they are legal documents. So there's a great deal of jargon that you'll find within those documents or those contracts. Okay, so let's go through a couple here. So firstly is a subrogation. The right an insurer has to claim the damages from a third party if the insurance company has already paid out for those damages. Okay, so the example that I'm going to give is if you're in an accident, you're not responsible for that accident. Okay, you weren't the cause, but you have claimed from your insurance company, okay, for the damages on your vehicle, okay, and the insurance company is paid out to you. But what they've now got to do, they've got to go and claim from the individual that caused the accident, from him or her or the insurance company. Okay, so that's subrogation. Reinsurance, when two or more insurers share the risk. Okay, this is if the risk is considered quite substantial. Okay, this could be in the financial industry or construction, for example. Okay, it allows insurance companies to share the risk and they both underwrite that risk. Okay, liability insurance. When we talk about forms of ownership, a sole trader and partnership are liable for the debts of that business or for any event that causes a loss. This insurance is to allow them to have limited liability in this sense. Peril, the cause of the loss. It could be a fire, it could be theft. Okay, reinstatement. In the case of overinsurance, the insurer may decide to replace or rebuild the product rather than paying out the insured amount. Okay, they might have access to a cheaper option, and this allows the insurance company to do that. Okay, excess, a clause which states that the insured is responsible for a fixed amount when submitting a claim. This is to avoid individuals or businesses claiming for small amounts. Okay, a couple of $100 here and there. Okay, so there'll be a standard fee which will come with each claim that is made by the individual or the business. Okay, principles of insurance. These are very important things that you need to keep in mind. Okay, so the first one is the average clause. Okay, the payment of the insurance claim will be according to the amount insured. Okay, underinsurance will be calculated and subtracted from the payout. This might sound a little bit complicated at this moment, but what we'll do a little bit later is we'll go through some calculations which will give you a lot far better understanding of this section. Okay, indemnity. Okay, payouts from insurance companies will only occur if there's proof that the event took place. Yeah, one of the biggest issues in the insurance industry is when people place claims for events that actually didn't take place. So there's got to be some sort of proof. So if you have a burglary or a robbery at your property, okay, you would need to have an affidavit from the police stating what was stolen. The police will need to come and check for fingerprints. Even if you have an accident, okay, you also need to go to the police station and get an affidavit, okay, showing that the event actually took place and what the damage was. Okay, insurable interest. A person can only claim if they are going to suffer a financial loss or liability. Okay, so they can't claim if there is going to be no loss. Okay, if there's no financial loss. Utmost good faith. The insured has to be honest in the insurance contract. So when signing up for insurance, the value of the property that you're insuring or the product that you're insuring needs to be accurate. Okay, you can't overvalue it at an inflated amount. Also, when you are claiming for property that's been lost, you can't inflate that amount as well. Okay, it's one of the biggest problems in the insurance industry is exactly that, because it does occur. Now, the next couple of slides are critical in the sense that in your exams, over the next 6 months, you are guaranteed to get these questions at some point in time. So the first one is the difference between assurance as opposed to insurance. So first and foremost, insurance, cover against an event that could take place or it may not happen. Yeah, so we have insurance against an accident in our vehicle. We have insurance if our house burns down. These are eventualities that could take place. Okay, we have the ability to cancel those at any time. So there are short-term insurances. Assurance, on the other hand, is cover against an event that is guaranteed to happen at some point. And you therefore pay a premium on a monthly basis for that. Yeah, it's normally long term. One of the examples is insuring yourself against your death. So life insurance. So if you do pass on or pass away, you will have an amount paid to your beneficiaries. Okay, I referred to that in one of the earlier slides. The difference between compulsory and non-compulsory insurances. Okay, so first and foremost, compulsory insurance. It's required by law. It's in legislation. Businesses don't have a choice but to take out this insurance, and it can never be cancelled. Okay, a premium is paid to a central fund, okay, and it is administered by the government. A couple of examples: the Unemployment Insurance Fund, the COIDA Compensation for Occupational and Injuries and Diseases Act, and then the RAF, the Road Accident Fund. Okay, so this is compulsory insurance. Non-compulsory insurance, on the other hand, is taken out at the discretion of the business, depending on what the needs of that business is or are. It can be cancelled at any time. Some examples are theft, vehicle damage, okay, and yeah, this is non-compulsory insurance. Insurable and non-insurable risks. Yeah, so there's numerous things that can be insured. Businesses can take out insurance for them. Non-insurable risks, on the other hand, okay, the businesses need to carry that risk themselves. Okay, there's no insurance company that will cover for that risk. So the examples of that non-insurable risks, the risk if a business fails. Okay, unfortunately, you as the business owner takes on that risk yourself. Risk of a possible change in fashion trend. Yeah, you might have invested in a whole lot of luminous clothing, but then a month down the line, this is no longer popular. So you cannot take out insurance against that change in the fashion trend. Change in technology. Scenario I'll give you is you own a business, you've purchased 1,000 Huawei devices, and you use the Android operating system, you use Google apps and Google platforms to administer your business, and now Google has decided to remove the operating system from Huawei devices. So you're unable to use those products. Okay, this is a risk that you take on as a business. Shoplifting, okay, unfortunately, you take on that risk yourself, and you cannot insure against that. Bad debt, okay. If you've got a number of customers that owe you a great deal of money, and unfortunately some have not been able to pay you back, and you have to write that off as bad debt, you cannot insure against bad debt. Time lapse between the ordering of goods and delivery. It's a prime example of what's happening right now with the coronavirus and the lockdown. Many businesses have not been able to receive the orders that they have placed a number of weeks ago. Okay, it could be sitting on a cargo ship in the middle of the Indian Ocean at the moment because the harbors are restricting entry of certain ships. Okay. Strike action. Okay. Loss of productivity because of strike action. It's unfortunately something that the business needs to take on themselves. They cannot insure against strike action and the losses because of that strike taking place.